you for coming. It's always fun to see everybody. I know Fred, Betty, I haven't seen you guys in a couple of years coming up from the Springs. Thank you. I know a lot of people come from all over town, so thank you very much. So let's just kind of get started. A lot of things are going on. Does anybody remember this guy? Yeah, just the facts. So we're going to start with just the facts. I like to talk about the facts to start with. What's really interesting is we must remember that 70% of the economy is the consumer. As goes the consumer, goes the economy. And what's really interesting is the economy has held up far better than all the experts said it would. The markets, as of yesterday, was up 14. Now the market's up again today because the inflation numbers were better than expected. So what's really interesting, though, is the consumer is actually been very pessimistic. And we talked about that last time I had a lecture in January. We talked about the fact that there was a survey of over 3,000 adults, and 75% thought we'd be in recession, 44% thought we were already in a recession. But what's really interesting is we see that the U.S. economy continues to grow strong, earnings are strong, people are still buying, people are still traveling. If anybody's been to the airport lately, it's a zoo. There's not a seat on the plane, and I know this because I have a Great Dane, and he travels with me, and they don't like it when he takes up 2 seats. But the interesting thing is, when we talk about 70% of the economy being the consumer, what's really important, one of Warren Buffett's best indicators is consumer confidence. And what's interesting about consumer confidence, and I talked about this in January, is that when consumer confidence is really good, markets don't tend to do very well over the next 12 months. But when consumer confidence is in the toilet, markets do very well over the next 12 months. So it's this dichotomy of, as Warren Buffett says, when people are fearful, I am buying, and when people are exuberant, I am selling. When people, and unfortunately, we as humans, we as herd mentality species, what do? We follow the crowd. I teach a class, and I always ask at the beginning of my semester, how many people think they're above average? And they all raise their hand. I go, okay, you just defined average. So it's interesting that it's hard to do the opposite. It is really hard to do, and I know that we all think we're unique, but when it comes to markets, I always get those clients call when the markets are down like last year. The S&P was down plus 20, the NASDAQ was down plus 30, and I got those calls. Get me out of the market. I want to go to cash. I think the world's coming to an end. That would have been the worst time to go to cash, and I did have clients do that, and now they're regretting it. So our motto is always invest. Cash is not an investment strategy, Susan. It's not. Okay, so let's talk about desperately seeking a soft landing. What is a soft landing? A soft landing is, can we get the economy back? Carl, I thought you'd like this. Carlisle was a plane aficionado and salesman for his whole life, and you never had that happen, have you, Carlisle?
No, I haven't.
Okay, that's a good thing. So anyway, here's what's really interesting. What is a soft landing? A soft landing really exists when you have turbulence in the global economy, which we did because of COVID. And you have inflation going stupid. You have the Fed aggressively raising interest rates, saying we need to slow the economy, which means we need to cause a recession. We need people to lose their job so we can get people to spend less, and that causes a recession and, of course, a market correction. Well, now the inflation, the CPI just came in today, I think, Pat, 3%? Was that what it was? Which blew away the numbers. Nobody thought inflation would be at 3%, and the markets are responding in a very positive way because now they're saying, well, maybe a soft landing is in the cards, but the dot plots, the futures market's telling us they're still going to raise another 25 basis points this month. Maybe they won't raise another 25 because pretty much was baked in another 0.5% going in through the end of the year and then holding. Maybe that's off the table. But what we have seen is we have seen a lot of job cuts across a lot of the tech and the banks. We saw that a lot of your, what I call the Magnificent Seven, has really wiped out a lot of jobs. So a lot of my techie interns may be in trouble when they graduate. In fact, I want to introduce Dylan. He's one of my interns in the back. Dylan is a master's student at the University of Denver, and he's doing a summer internship. Dylan used to be a production engineer for video work. So I have him doing all this video work, and he's like, Tom, I didn't take the internship to do video work. But I said, no, we'll teach you financial derivatives. But what's interesting is I do have a lot of clients that live not in Denver. And so I want to record this, and I do put these on the web so they can watch them. And that's why I'm doing all this recording stuff right now. So anyway, job cuts are been very prevalent in the tech industry, but that's what's made the tech industry explode. Really, the Magnificent Seven has been driving this rally. We'll get into that in just a bit. Hiring slows more than expected. That happened last week. So job growths have slowed. The inflation numbers have come down. Is this really the perfect time to invest? Consumer confidence is still lousy as of the last report. And let's talk about employment and wages. Now that's kind of interesting. Let's blow that up for the people in the back. So let's look at unemployment rate. The average is 6.2. Right now, unemployment is 3.7. If you look at the trend line on this, it's below trend going all the way back before 1994. So how do you have a recession when you have full employment? How do you do that? You can't. You can't. Everybody's working. Where is the recession? So, and it's also interesting is now wage growth is interesting because wage growth is running about 4%, which is as high as 5%, and wage growth is 4%. Why that's important is because, say, well, that doesn't really help because if inflation is at 6% and my wages are going at 4%, I'm still losing ground. But if CPI drops below 4, which it did today, you're getting people saying, okay, I can afford my eggs now because I'm getting a positive return. My salary is making up for the increase in wages. The problem is the government lies about inflation, right? Go figure on that one. We'll get into that in a minute. So is inflation really 3%? I don't think so, but if the government says it is, and that makes them stop raising rates, I don't care. So let's talk about the inflation map. Where's inflation coming from? If you look down this list, you can see that really the biggest benefit of reduced inflation is coming from energy. All the other categories have been pretty sticky. You know, I was listening to Bloomberg on the way down here, and they were talking about, okay, so when are retailers going to start reducing prices? I'm like, what are you kidding me? Really? When is Best Buy going to start reducing prices, or when is Walmart, or when is Costco? Really? No, retail doesn't reduce prices. Services, when is my contractor going to start reducing prices? I need something fixed. I don't think that's going to happen. But anyway, energy is, I think, really is this energy, commodity prices have really been coming down hard. And that's really because of supply chain issues, because they've really been able to clear out since COVID. This is really an interesting slide. I want to blow this up. And why this is an interesting slide is revenues have come down. They've been cut in half. But margins have doubled. So the earnings picture, which they're going to start to report, today's Wednesday. I guess the first report, Pat, is Friday. The banks, I think, report on Friday. And by the way, everybody knows Pat. He's my head trader, and he runs my quant team. So anyway, the bottom line is that, so what we're seeing that earnings are actually pretty good because people are just doubling their margins. Rick, you're doubling your margins, aren't you? Just charging more for your...
Oh, yeah.
Okay. So you're gouging, okay? Rick is a gouger. But that's what's happening. A lot of people are gouging, and that's the problem. People say, hey, we can charge more, so let's charge more. So that's kind of interesting. So what we have here is we have the Fed's funds rate. That's what makes interest rates go up. Mortgages hit 7.3% today for anybody looking to buy a house, Mark. It's kind of tough when you could have refinanced at 2.75 a year and a half ago. So ouch, 7.3. So here's what's interesting. They're expecting 5.6. That may come off after today's print, but 5.6 would put us at rates we haven't seen since the turn of the century, 23 years ago. That's pretty exciting. Now, why do I say that's exciting? Because we're going to get into some of the out-of-the-box stuff that we do at the firm. But anyway, borrowing costs have hit a 16, probably close to a 20-year high. We're seeing that wages, people are having trouble finding employees, especially the service industry. Are higher interest rates going to crash the market? I touched on this at the last luncheon, and I wanted to bring it back just quickly. What I basically see from this data is, of course, I'm just looking back at the 70s. What happened in the 70s was the Fed's funds rate went high in the early 70s. They dropped it back down in the late 70s, and then inflation exploded, and then they started to rise rates up to 20% by 1980. But really, all I was looking for was a correlation between the equity markets, the stock market, and interest rates. Because everything I read tells me there's a high correlation. If interest rates go higher, it's going to crash the market. I don't see that. I mean, when interest rates are at 20%, look what the market did. Now, yes, there is a lot of volatility, but we shouldn't be afraid of volatility. Not if we're managing money correctly. Yes, markets go up and down, John, there's no doubt. And when you call me up and go, hey, what's up with this? I'm like, hey, calm down, have a scotch, relax. Things will turn around. Yes, sir.
So are you implying that with raising interest rates, we have increased volatility?
Yes, we do. I am implying that, but I also don't see the markets getting destroyed.
Right.
What the numbers indicate, Rick, is that when the Fed starts to raise rates, markets tend to have a down year, and that's exactly what happened last year. But about a year later, I do have a graph, a chart, but it's hard to see, but the chart says a year after they start raising rates, markets tend to rebound, and that's what we're seeing now.
And the VIX right now is like all-time low, right?
No, I think the VIX is, what, 15, 14?
Yeah, I mean, it's as low as it's been since the pandemic.
Yeah, I mean, it's 2-3 years lows since, well, remember, the VIX is the demand of options in the SPX pit. So the VIX started to explode in early 2020, and it hasn't been this low since early 2020. So you're talking 3 years. Yeah. So anyway, very good. So anyway, what we're also seeing is the dollar was really at a very high. It's come out 10% off its peak. But still, the dollar is trading, the strength of the dollar is still where it was back in 2001, 2002. And I know, John, you get those ads where the dollar's going to zero, buy gold. And I had an argument with Vince. Where's Vince? Vincenzi. Vince is a new employee of the firm. Stand up, Vince. Vince. Now, Vince is new. He just graduated from CU, and then he was my TA at a class. And then I said, hey, you want a job? And I pay him minimum wage, and he's hoping to make more. No, I'm kidding. No, he's doing good. But the bottom line is, I had an argument with Vince about the dollar. And why we had an argument about the dollar is because, just very quickly, remember, I don't know if we remember this, just a little history lesson. In the 1970s, we were running massive deficits because of the Vietnam War. And we were backed by the gold standard. The Bretton Woods Conference was signed in 1945, which said that the U.S. was the reserve global currency and that we would back our money with gold in Fort Knox. Well, Nixon started to spend money like a drunken sailor during the Vietnam War. And what happened was the rest of the global world said, you know what, we want out of the Bretton Woods Conference, give us our money back in gold. And Nixon took us off the gold standard. And the minute he did that, the dollar crashed, the gold exploded. Nixon actually had a Swiss bank account, and he made millions of dollars on that. But that's a sidebar. But what's really interesting about that story was that him and Kissinger, the Secretary of State, said, well, what were you going to do? So Kissinger went to Saudi Arabia and he said, let's see if we can get the Saudis. We'll give them all the weapons. We'll protect them from all the countries in the Middle East. But everybody has to buy oil in U.S. dollars. That became the petrodollar, and the U.S. dollar exploded back to the reserve currency. But here's what's interesting. Since that time, Susan, that money tends to flow to where it can get the highest rate, but more importantly, where it's the safest. And the U.S. is the safest economy and the most stable economy in the world. So it's no longer a question, because I know, Vince, you were arguing that China and Russia are starting to buy oil in their local currency, in rubles, in renminbi, in yuan. And I told him, you know what? The Saudi princes are going to put money in treasuries because they know they can get their money out. You're not going to put money in China. You're not going to put money in Russian rubles, right? You're talking about, well, they could just say, hey, we're keeping your money. A friend of mine who's Lebanese, right, she basically was destroyed because the banks just took all her money. So I think the dollar's always going to remain strong because we are the best looking horse in the glue factory. There's no other, I wouldn't be in euros, I wouldn't be in sterling or pounds, British pounds. So I think that's the argument. Quick sidebar, for the first time in 20 years, since China signed and became part of the World Trade Organization, Mexico has imported more products than China last month, Mexico. So what's happened is that the U.S. manufacturing base, because of China shutting down, they said, can we depend on China as a supply chain? They started to diversify. China could have shot themselves in the foot. Not an economy that I would want to invest in, even though the market's down. They're in deflation. They have a really bad housing problem, worse than ours. So anyway, that's an interesting sidebar. So anyway, let's talk about the global activity. Global activity is strong. The global economy is alive and well. Anything above 50 means expansion. And the only economy below 50 is France. And they're all communists in France, aren't they? I don't know. Anyway, that's kind of interesting. So if we look at where the growth is coming from, US, Europe, Japan, we can see that the US growth, the Magnificent Seven is driving the US economy. We'll get into that. And I know, Dick, you're involved in the Magnificent Seven. But in other countries, we're seeing, like Japan, a lot of value. We're seeing in Europe a lot of value, a lot of momentum. So what's really interesting, and I'll talk about it in a minute, are we going to see rotation from growth into some sectors of the U.S. economy that really haven't participated? In other words, the value, the Russell 2000, really hasn't done much this year. More of the small cap. Are we going to see people taking profits, Dick, from some of those big tech names and saying, let me diversify maybe into some of the more companies that really have better valuations? Price to earnings valuations. So anyway, this is the head of the Federal Reserve. This is named Jay Powell. And he's the one that decides. He's the chairman of the Federal Reserve Bank. And he decides if interest rates are going up or down with his team. But he basically says he's not going to make the mistake of the 70s. In the 70s, interest rates really were flopping around, high, low. He's saying, I'm going to try to keep interest rates higher for longer. So maybe we see 5.5 for 2 or 3 years. Because the economy is doing good. I really don't see a recession. That's my opinion. And if we do, Powell basically says he sees a recession, a light one, and he's pushed it out to 2024. In his recent talks, I just pulled this off the Financial Times. In any way, tightening credit conditions could be a headwind, but that might be abating. Consumers held up remarkably well. Minimum wage increase. This is an interesting one. What does minimum wage have to do with the economy? You know, it's interesting. I remember when Ronald Reagan was trying to win presidency, and he ran against another Republican called George H.W. Remember George H.W.? 1,000 points, I don't know, I can't do him. But the bottom line is, they used to argue and debate about voodoo economics. And voodoo economics is, Reagan believed in what we call trickle-down economics, where you give money to the rich and they give jobs to the poor. That's Friedman economics. That's called trickle-down, and Bush would call it voodoo. That's voodoo economics. Well, what's interesting is Keynesian economics, which believes in demand side. Give more money to the poor people, Poor people spend 100% of their money. Rich people save. Susan, if I gave you 100 grand, you'd probably save 95,000 of it. No, you wouldn't? Okay. Anyway, so the point being is that what's really interesting is Powell's saying that this has possibly made the economy done better. You know, what's interesting is I got a quiz for everybody. Rick, see if you know this one. What is the number one, according to economics, what is the number one stimulus, economic stimulus the government program could put out? The number one stimulus based on the economic numbers. What stimulus gives the most economic benefit? No. Welfare, close, but no. Anyone else? Food stamps, very good. Economists, so believe it or not, for every dollar I put in a food stamp, I get $1.71 in economic activity. And if you remember when Obama was president, he exploded the food stamp program. He was getting vilified by the Republicans because he's saying, what are you doing? He's saying, well, Dr. Bernanke, who got his doctorate in the Great Depression, basically he's telling me, let's stimulate from the poor. And so I think that's what Bernanke's talking about. I mean, excuse me, Jay Powell. I think he's talking about raising the minimum wage. I think Colorado's, what, 15 or 20? I don't know what the minimum wage is. It's not Florida. My niece just graduated from, I like to say FU, and she says, Uncle Dom, it's UF, University of Florida. She gets mad at me. But, you know, I'm saying, Maxine, what are you doing? She's saying, well, I'm working for a cold call center making $7 an hour. I'm like, what? How do you live on $7 an hour? But a lot of states have gone to a higher minimum wage. I think California's 20. Is California 20? I don't know. But anyway, that's an interesting parable, guys, that the minimum wage actually is maybe a reason why this economy has held up so well. Personal savings rate has fallen. I think a lot of people have coming off COVID. The average rate's 8.9. It's down to 4.2. Credit cards, balances are exploding. Defaults in banks of credit card is going up. So that might put a drag on the economy, but maybe that's good. Maybe that makes Jay Powell pause. Maybe that makes him pause. But all we know is that a lot of people are saying, screw it, I'm going to put that vacation on my credit card and I'm going to go to Costa Rica. I'm going to go to whatever. And that's why I think we're seeing a strong economy. The cruise lines are up over 100%. Airlines are up over 28%. I mean, it's crazy, guys. But I don't know, this word recession, I don't know if that's happening. And why I think that's important, let's just talk about the word recession. When I look at the numbers, and I look at the numbers of recessions going all the way back to 1948, other than the credit crisis of 08, these numbers don't scare me. These numbers, that's not good. But look at the average recession, the return of the stock market, denoted by the S&P 500. During a recession, the average return's been 0. And the median's been 5.4. So when I listen to the news and they say recession, oh my God, let's go to cash, I'm like, I don't see the data that tells me I should be concerned my clients are going to lose all their life savings in a recession. So I thought I would bring that up. Should we fear a recession? And I don't think the recession is going to be big unless, I don't know, Russia decides to do a nuclear bomb. Maybe that's not a that's a bad thing, Dick. Then you're talking, Pat, I don't know, we go limit down on the futures market. The market closes for the day. Yeah, the Wagner Group. Yeah, that's something we could talk about.